saying you should invest in index funds is the financial equivalent of saying eat more vegetables. It's good advice, it's just very boring. So what are index funds and why should you own them? Well, let's take a look. An index is simply a way to track or measure the performance of some portion of the stock market, and one of the most popular indexes is the S&P 500. So it's a collection of 500 of the largest companies in the US that fit a certain criteria. And you'll likely recognize a lot of the companies that make up the S&P 500. Microsoft, Apple, and Amazon are, of course, three of the largest, but there's hundreds of others. And rather than have me read through 500 companies, as entertaining as that might be, I'll just post a link in the description, and if you want to take a look and see all the companies that make up the S&P 500, you can certainly do that. When the S&P 500 was first created back in 1957, it wasn't something you could just go out and buy. It was just an index to track the performance of large cap US stocks. Sure, there were funds that invested in a lot of these same companies, but they were generally actively managed, meaning that managers and analysts would pick the stocks that they expected to do well. And as it turns out, managers and analysts don't like to work for free. It's common to see fees of 1% or more for actively managed funds, and while 1% doesn't sound like a lot, compound that over decades and that can take a big bite out of returns. And that's just it. A lot of people began to realize that most of these actively managed funds were actually underperforming similar stock market indexes. A lot of that had to do with their fees. All this underperformance made people realize if they could just find a low-cost way to invest in the S&P 500 index, they'd be better off. And in 1975, Vanguard founder Jack Bogle launched a fund that did just that. And things got even better for investors in the 1990s with the arrival of exchange-traded funds, or ETFs, which are similar to mutual funds, but they have a little bit different structure and generally have lower fees. All of this adds up to there now being a ton of low-fee investment options for investors, and I'll put the ticker symbols of the ones we talk about in the description so you don't have to hunt for them. The big three when it comes to S&P 500 ETFs is the Spider Shares, iShares, and Vanguard S&P 500 ETFs. So if you look at a total return chart over the last 5 years, so this incorporates dividends, the performance has been pretty much identical, which makes sense because they're all investing in the same underlying companies. One thing to note is that each one of these funds, the per share price is around $300. So that means you'd have to invest in a $300 or so increment. If you want to be able to invest in smaller increments than that, there are mutual funds that do basically the same thing. Charles Schwab and Fidelity both have good ones. And if we look at Charles Schwab, the gross expense ratio for their S&P 500 mutual fund, so slightly different from an ETF, is 0.02%. So again, incredibly low expense ratio, and they'll let you invest with $1. So you could invest in, if you want to invest $20 a month, you could do that. Fidelity, same sort of thing. They're actually just 0.005% lower in expense ratio than the Charles Schwab fund. I bet that's intentional, but sort of funny. And again, initial investment, you don't really have to worry about minimums. Here, that's a $0 minimum. Just make sure with any of these mutual funds that you're paying attention to whether your broker is charging you a fee for the transaction, for the actual purchase. And on occasion, there can be early redemption fees if you buy shares or buy into a mutual fund and then turn around and sell that within a short time period. It could be 30, 60, or 90 days. There can be an early redemption fee for that, so take a look at that particular fund or take a look at your broker's site and just make sure you're watching for those things. There are tons more index funds that you could choose from, things that focus on international or small cap companies. I'll list some of these in the description, but an S&P 500 index fund or a total market return index fund is a great place to start. So while not particularly exciting, owning and investing in a consistent basis in index funds is one of the best things you can do for your financial health. And while you're at it, why not eat some vegetables too? Thanks for watching. If this video was helpful to you, consider clicking the like button and subscribing if you want to see more videos like this. If you hated this video, go ahead and click the like button, just do it sarcastically and I'll know what you meant.